Hello and welcome to another episode of the Saxo Market Call podcast. As always, my name is Søren Otto and I am your host. And today it's autumn break here in Denmark, and that means that we aren't that many people in the office.
Only the American is hanging around the office.
Because you guys don't take any holidays.
That's the stereotype anyway.
That is the stereotype for sure. So we're just two here. Me and my great colleague, John J. Hardy, Chief Macro Strategist. Hi, John.
Hey.
And I'm sure we will be, or at least you will be, more than capable of taking our listeners through what we need to go through today. Because as always, stuff is happening out there in the markets. And we're going to look a little bit at sort of financial news. We're going to talk a little bit about the storms. And obviously, we're also going to talk a little bit about the storm that is the U.S. election, which is getting closer and closer. But sort of from a very helicopter perspective, before we jump in, John, what is the key things that you're paying attention to right now?
Yeah, we have some pretty remarkable market conditions here in a couple of ways. One of those is quite obviously that we have U.S. equities hitting all-time highs, at least in the case of the S&P 500. We're looking at this astonishing 6,000 level coming into view, nearly 10 times the lows from 2009, if you can believe that, at least in nominal terms. But it's also it's not just equities. So it's a combination of, we have equities up, we have at the same time the US dollar up, and we have a sharp rise in US yields. What is this all about? That's, by the way, quite an unusual set of correlations when you have all of those ripping at the same time. And I think what it might be, of course, on the rates side, you could argue it could be the economy, hotter than expected. There's the so-called no landing scenario coming into play that could arguably be good for no landing could be good for the economy, because obviously there is no landing, so we get a speeding up economy again. But the rates thing, that's maybe a risk for risk assets. It's either that, or it's maybe as well, and I think partly it is that, but I think as well the market may be putting on a Trump 2.0 trade. We've seen quite an extension in Trump's lead in the odds makers assessment of the election odds, and the polls continue to tighten in favor of Trump. So if we look back at the 2016 election reaction, we had that combination of factors as well, as the market knew, well, you got Trump plus control of Congress. That's going to mean massive supply side tax cuts, which will boost valuations in the stock market. It'll boost long-term yields because growth will be boosted massively, and it's good for the U.S. dollar as well. So I think that's a little bit of a combination of what's going on here in the markets. It's a bit hard to dissect what is what, but that's just the feeling I get.
Makes total sense, John, and why don't we stick with the U.S. election as the first thing here, because it is obviously increasing in momentum, and as you say, it also seems that Trump has increased his momentum in the polls, or maybe actually the opposite, that Harris has lost her momentum. I know it's something that you look a lot at these days. What's your take on the election and the status there right now?
Yeah, well, I think what we just said sort of describes it all. We have, for whatever reason, there seems to be just the energy seems to be ebbing out of the Democrats' commitment or excitement about the Harris-Walz ticket. You also have around the edges, you're seeing that these polls of traditional so-called minority voters, so Hispanic voters and black voters. We already saw it in the 2020 election that higher percentages, especially of black men, but also Hispanics, broadly speaking, voting more in favor of Trump than they had in the prior election. So the demographics and the makeup of the electorate seems to be different this time around.
And just a little bit of a sort of a commercial plug. You're doing a webinar later today, Danish time, right? Which is also about the U.S. election.
Yes, doing a webinar with special guest Blue Putnam, former chief economist and managing director at CME Group, the futures powerhouse. And we'll be running through all of this. And even if you are listening to this podcast after the fact, no fear, we'll put out, of course, a recording of the full webinar. And it really is a good chance to get into depth on everything election related. The first section will be looking at where the U.S. economy is in general. I think it's a very key question, something the market is struggling with in the background anyway, with or without the election, as we're trying to figure out, we thought we were going for a soft landing or hard landing was the question. Now the question is it a soft landing or no landing? So there's that part. We'll also be looking at the U.S. election odds themselves and the specific scenarios and the likelihood of those. And then finally, how the different potential election outcomes could impact financial markets. So it's a full, at least 1 hour rundown of all these factors, and a great special guest, Blue Putnam, on that too, with me hosting, looking through all these issues.
All right, and if you wanna attend the live version, then you can sign up on our platform and our website, and as you said, otherwise you can listen to the recording afterwards, and you can find that in the same places. Definitely think that's gonna be a great show that everybody would like to pay attention to.
One thing I would flag, so we ask ourselves what could change between now and election day, and we've seen quite an evolution of these odds. It's a little bit more like 2016, where I recall it sort of almost like a sine wave of mean reversion of the polls back and forth. Trump slightly ahead of Clinton, Clinton slightly ahead of Trump. The current snapshot is not necessarily what we get on election day. So we
Sure.
could see some further mean reversion back the other way. We could also see sudden jolts. I'm just looking out there. What could possibly jolt public opinion? And I would just zero in on, I saw the headline crossing the wires that Trump plans to do the Joe Rogan podcast. And I think that's a really interesting chance for people that may not have been listening to Trump or maybe sitting on the fence and haven't really sat there and listened in, but they are listening to something like Joe Rogan's podcast, which is listened to by millions of people. It's a free-form conversation. I think it has actually more risks for Trump than more positive. I think people that are pro-Trump already sort of know his persona. So I'm curious if this could be one of the last things that could influence where we're headed in this election prior to election day, which is now 3 weeks away.
Yeah, actually today it's crazy.
Yeah,
definitely. But John, you talked about this Trump trade, and I know that that's a term that's been flying around, and it's very, very fancy in media to say the Trump trade. Could you just decipher for the guys out there that aren't that familiar? Is it just the idea of positioning yourself towards a Trump presidency, or is there anything more to it?
I think it is, and again, the temptation is to pull out the 2016 post 2016 election playbook, where you have the idea that if Trump wins, and it's so important, it's not just if Trump wins, he has to get both houses of Congress. There are scenarios in which he does win and he gets the Senate. The Senate, to me, is just totally impossible for the Democrats. But that the House just barely does not get in control of the Republicans, and that is a game changer because that prevents the more sort of risk, obvious risk positive sides of the Trump trade, those being the anticipation of fresh corporate tax cuts, which he'll only get through if he has control of Congress as well. The idea that they'll move to 21% down to 15%. And then a lot of the deregulatory moves. Whereas on the tariff side, because of the ability to do those via executive order on so-called national security grounds, the tariffs generally seen as market negative for good reason, bad for growth, inflationary or stagflationary, if you will, in their impact, that would be seen as negative. So it's not just Trump; it's Trump sweep or Trump with a divided Congress, or Trump gridlock, if you will. So. But that Trump trade is very straightforward. So assuming a sweep, we get new tax cuts, yet another supply side boost to the economy, a little bit akin to 2016 and the eventual 2017 Tax Cuts and Jobs Act. However, we have to consider what the impact of Trump's platform would be on U.S. deficits. The estimates are pretty remarkable. At minimum $6 trillion over 10 years in fresh deficits. Some are arguing 7.5 plus. And that the idea that these tariffs would offset that is seen as unrealistic. So it just looks like something that would spin U.S. Treasury yields out of control. Of course, the Fed will do what it can to prevent that. The fiscal the government must always be funded, but once you start to weight in on monetary policy to impact where things would be headed without these sort of limits on interest rates or caps or whatever it is the program is to control the situation, it's really difficult. It's a difficult one to game out, and I don't think that we can argue that it's just unreservedly positive for assets. I think the main thing it clearly is inflationary with a big I. Okay. It is the most inflationary scenario far and away to have a Trump that has control of Congress and is doing fresh tax cuts and fresh erosion of the U.S. Fiscal sort of credibility.
So John, if we buy the premise that some of the movements we've seen recently is this Trump trade, one of the things, I mean, we've put a certain amount of attention to the U.S. election over, I guess, the last few months or even more. We started in spring. And one of the things we started discussing was how much does U.S. elections actually impact markets? And let's say at least we went to undecided that it's not always that it has a big effect. But if we play the game and say that this is actually the Trump trade, and we look at the polls that are still quite close, if something apart from a Trump sweep would then happen, I assume that we could expect some volatility related to this specific election that we're leading up to.
Of course, but you only know on election day how the market was positioning. So you could say the market is not really positioning if it had stayed in some kind of nervous range and not much was happening. But we have some pretty sharp moves here. So we have, it looks like we're baking in some scenarios, and that Trump trade, the Trump 2.0 trade, the Trump sweep seems to be at least partially getting priced in. I think there would be further to go on this trade if we crystallize the reality of a Trump 2.0. The most negative scenario, though, on the flip side, would be a Democratic sweep. Let's say we have the polls completely wrong. Let's say that there's a huge turnout, a new turnout situation among younger voters. They vote overwhelmingly Harris, and the Democrats somehow miraculously also get control of the Senate. It's just a clear negative for markets because it will get the opposite. We're going to get the Democrats resetting corporate tax rates higher rather than lower from 21 to 28%. Also inflationary because of some fresh fiscal moves, about half of what's seen under Trump's platform. But it just, while the Democratic sweep is supposedly priced by odds makers at nearly 20%, I think it's just very, very difficult for me to understand how the Democrats get the Senate. So if we do see Harris win, I don't think the Democrats have control of Congress, and therefore we just kind of have a status quo. So then we have to figure out where the U.S. economy is more than anything else in that situation.
Yeah, just quickly to emphasize, it's not that you personally see it as very negative if we see a Democratic sweep. It's for the markets.
It's clearly just the market needs to adjust to that because you're going to need to revalue companies according to a new corporate tax rate. It's just not black and white, but it's very simple maths that need to be done on valuation models, assuming that the corporate tax rate would rise to that new level. Yeah,
definitely. And if you want to read more about John's thoughts on this and also how these scenarios play out, you've written some excellent, pretty long, but absolutely excellent pieces on our platform and our website. That's definitely worth a read if you're interested in the U.S. election.
Just look up Saxo U.S. election coverage or something like that if you want to Google it, if you're not familiar with where to go.
Then you'll definitely find it, and I can only encourage you to do that. But now let's take a little breaking sound and then move on to another topic. Because, John, when we are trying to evaluate something like whether we're seeing the markets move into something like a Trump trade or not, then one of the answers could lie in data, general data about how the markets and how the general economy is doing. But as we just talked about before, some of this data will be distorted in the near future, which will challenge this picture even more, and that is due to, among other things, but especially the horrific hurricanes that we've just seen, Mitchell and Helen, I think.
Milton was the latest one, and a new name that I wasn't familiar with before, and then Helen, the French, I guess, Helena, that hit and caused a lot of devastation, especially in an interesting, we'll talk about Blue Putnam. I think we'll talk about this more than I will, that some of the counties up in Appalachia, so I guess North Carolina, Northern Georgia, etc. This was Trump country. That could this actually affect voter turnout in some key Trump districts, rural Trump districts in Appalachia? I have no idea on that. But what is clear is that it does impact jobless claims, and we already saw that in last week's. I think it was a 258,000 print. We've become used to this range, 230-ish K range, and a storm or a dual hit like this, Milton hit a very, very heavily populated area of Florida. Thankfully, the worst case scenarios did not happen, but there is a heck of a lot of disruption. And we could see this impacting these claims for another 6 weeks. And it's really difficult. As I said earlier, when we're all trying to figure out where the heck the U.S. economy is in terms of the landing scenario, it's one of those higher frequency indicators you look to see if you can get a sense of the trend in the economy. And when you have to filter out these kinds of impacts, it just means that we have to almost wait for January, February data on employment before we have a sense of even a weekly indicator like that. So it'll affect the jobs report. It'll affect the Fed. Will try to look through it, but it'll also affect their decision making at the November FOMC meeting, coming just 2 days after the U.S. election. By the way, it was delayed. I don't remember when it was originally delayed from, but they didn't want to hold it certainly the day after the election. The normal Wednesday you have FOMC, so they're actually holding it on a Thursday, so 2 days after the election.
That's also going to be an interesting meeting because chances are we don't even know who's going to be the president. But
and then the whole it suddenly looks like a controversial move to have gone to 50 basis points, and now you even have the market only about 90% on whether they're going to go for even 25 now. A very interesting meeting in how they position that, especially how they position themselves in the event Trump wins, the Trump 2.0 scenario, because they have to know that they're looking to a scenario where they will be desperately scrambling to figure out how to keep the U.S. bond market and U.S. rates under control when Trump unleashes this inflationary blast into the economy.
Could you just I know this is very, very, very rudimental and very, very low key, but could you just explain why it is that these hurricanes are affecting these jobless claims, just so everybody is aware?
Well, I mean, the U.S. Job market, so many people have the job market is very different from here in Europe. Your contract is 2 weeks notice kind of a contract. And when you have millions losing power, a lot of U.S. Power lines are above ground, so it takes a lot of time to run through neighborhood by neighborhood with capacity where it is to repair these. Just economic activity gets significantly disrupted, so you just get dropped from the payrolls, and you have to get some kind of you have to file claims to get unemployment benefits. And it's not because you're going to be permanently out of the jobs market. It just might take you a month or two for the community to get back on its feet and for you to resume your presumably somewhat service-related job. So that's the type of disruptions we're talking about. And it's the same reason why the pandemic impact and the need for stimulus in the U.S. was so different from, let's take a place like Germany, where you have these, it's extremely difficult in Germany or in France to fire workers. It's almost impossible in France, right? So the government moves with existing sort of stabilizers to just ensure that that the companies are funded, and that there's not a huge disruption, without needing to worry about suddenly that there's millions of workers or a high percentage of workers that are out on quote unquote out on the street, if you want to put it that way. Whereas in the U.S., again, with this very short notice period, and there's less in the way of red tape in terms of letting go of workers. We saw these crazy, what was it, 23 million, I think, or 21 million was the jobless, or the non-farm payrolls drop from 1 month to the next, right? So you have to scramble to just shower cash on people, shower checks on people, rather than sort of just supporting the existing system by funding companies a bit more to make sure that things are stable. So a very different stimulus approach, and the outcomes are you get more inflation in a place like the U.S.
So, do you expect these hurricanes to have any wider impact on financial markets? Have we seen any movement, anything that would suggest that they have? I guess this is sort of a hiccup, not to play down the severity of the hurricanes, but from a financial markets perspective, sort of a hiccup. On the way.
If you look at broad U.S. growth, you're talking about it impacting an area that's just a percent or so of the U.S. population, maybe a bit more than that on the second one in terms of the what percentage of the U.S. economy it impacted, and then on the other side of the sort of the cessation of activity, you get the rebuild efforts, which are actually stimulative for GDP, because you have to scramble to rebuild stuff that was destroyed by flooding and wind damage. So they have an effect, but it's a ripple effect, and it's not huge. I mean, Katrina was much bigger because it was a far larger damage that was caused by Katrina back in 2005 in the New Orleans area, if you recall, but it was also because it was critical refining infrastructure that was impacted, and suddenly you had gasoline prices spiking to incredible levels, and that affects people's pockets immediately, whereas that type of impact has been completely avoided in this situation.
Okay, John, let's move into the third and final part, which maybe, I guess if you wanted to title it, it could be a little bit of everything. But
grab bag.
Yeah. But I think one of the areas where we should start is that even though everyone is paying attention to elections, etc., we also have an earnings season kicking off, and as always, they come every quarter. Do you have anything? I know you're not an equities guy per se, but what's your take on the earnings season?
No, but it's always an important check-in to the health of different parts of the economy when you have an earnings season, because you get some color on different companies that are reporting from different sectors, whether it's consumer, how's the consumer doing? I think you can sort of assemble a patchwork look at that. So I'm really curious how services companies are doing. Let's say restaurants that are in the the medium tier, just what the average person is feeling in terms of pressure on their pocketbook. I would say, broadly speaking, there was some interesting signs of some pressure the last earnings season. It wasn't profound enough, obviously, to trigger concerns of a hard landing. So, what are the Walmarts of the world seeing? What are the other higher tier companies that are in services and consumption seeing? But really, I mean, the broad obsession in this market is everything AI.
Yeah.
I mean, it's where all the attention is, where the bulk of the attention is. Unfortunately, NVIDIA does not report until the 21st of October, so that's some ways off. But you get some little samples and bits and pieces of what's going on in the space from a number of other companies. There's AMD coming up here, and one this week and tomorrow, in fact, is ASML. A bit of an early on in the supply chain, but still a very important player in AI because it sells this chip-making equipment, etching equipment for chips. So what they're saying and what their forecast is could have tremendous influence on the space. But that'll be my focus as we look at earnings season. How's the consumer doing, and then anything AI and tech related, and anything that shows our companies upping their investments or pulling back on their investments in AI. So if we're talking about the big consumers of AI, the biggest ones being the Mag 7 type stocks, the big infotech giants. Those are the ones that are building server farms so big that they're talking about. Was it Google? I think it was Google talking about funding some nuclear reactors so it can build a massive data center to power AI research.
Yeah, and all of this electrification wave is incredibly interesting related to that, and also something that we've discussed at length with Peter, that at some point AI needs to show some kind of profitability, not just being a very cool techie thing.
Yeah, it needs to show the application that is worth all the investment.
Yeah, exactly. I'm sure that earnings is something that we're going to cover in the coming weeks. But is there anything? You mentioned that we needed to say something about China. What is it we need to say?
It obviously, if you look at Asian markets, look at the Hang Seng Index, look at the Chinese mainland markets, we saw a tremendous and look at some reactions, spillover reactions in the commodity space, et cetera, the Australian dollar, to China's announcement that it is sort of putting a floor under the equity market, clearly supporting the equity market directly, clearly supporting the wanting to support the property sector more by easing up some rules on taking on mortgages and doing some easing directed towards banks, interest rate cuts, et cetera. But China is in a massive balance sheet recession, and what people are looking for is for more fiscal stimulus, directly supporting consumption. And they've been a bit cagey about that, and we're not getting the type of news that the market is looking for that would really unleash that sort of new demand into the local economy, but also the global economy. So until that is forthcoming, these types of easing measures on the sort of interest rate and to ease the burden of debt don't really have much impact. So is this a big dud? Is this a big something that's not going to pan out, or is China super serious about reflating and willing to allow the type of and unleash the type of fiscal stimulus that would both get demand going again, but also potentially risk inflation? So until that question is answered, it's just a massive question mark for markets, and I don't really have any visibility there because I'm not sitting on the CCP meetings that would look at this. So it just needs to be on everybody's radar because China can move global demand and global inflationary outlook at will. Yeah,
and it will be interesting. I mean, we have for so long, I feel like we've been talking about China needing to do something, and it's going to be interesting to see if this is what they will be doing to try and rectify the challenges they've had in their economy.
Yeah, and then I think the final note is not just looking forward to data or certain events, but it's just looking at the U.S. 10-year. I think the U.S. 10-year is just a great benchmark and just a thing you have to pay attention to when it's moving in a big way, especially to the upside. We've seen this comeback in U.S. rates ironically post the 50 basis point cut from the Fed. U.S. 10-year trading back above 4%. The comeback in yields is so far it's sharp, but it's relatively benign until as long as we're getting the hope for growth, etc. But if it goes above about 4.5%, I think it might start to become a little bit unsettling for the market. So just keep the 10-year yield if it's not something you have a habit of looking at. I think there's some kind of inflection point where higher yields begins to give the market a bit of pause.
So look at the 10-year and pay attention to China. I guess that's the final word.
Yeah, then all your earnings coming in and the U.S. election. It's easy stuff, right?
And just exactly. Yeah, and just a final note. If you want to remember to check out this webinar that you're going to have, I think it's at 7 Danish time.
8 o'clock Danish time.
8 o'clock Danish time. All right. So
7 o'clock British time.
Yeah. All right. Good stuff. So check that out on our platform or our website. John, thank you so much for coming and sharing your wise words with us. As always, it's always a great pleasure. And as always, thank you for joining us today, for listening in. If you want to hear even more from John, as I said, you can check him out on our website or our platform, but you can also find him on X at John J. Hardy. Thank you, as I said, for tuning into the Saxo Market Call. If you have any feedback, then please rate us or send us an email at the Saxo Market Call at saxobank.com, and then we are happy to hear what you think of the things we're doing here, because we always want to get better. Otherwise, join us next week for more insights on the market forces shaping the global economy. Until then, stay informed, and invest wisely.